Good evening and welcome to the Brian Crombie Radio Hour on Saga 960 AM News Talk Radio. I have the privilege of every night at 6 o'clock bringing you interesting interviews with fascinating people. And one of the gentlemen that I have a lot of respect for, I've had the privilege of going to several of his investment dinners, is a gentleman by the name of Hussein Ahmed, who is the owner and founder and head of Yorkville Asset Management, a money management company here in Toronto. And he's got an incredible wealth of experience in the markets. And I was thinking that it would be great to hear from him what he thinks about what's going on, both with the markets, but also, different government responses to COVID-19, et cetera. So Hussein, thank you for joining us today.
Welcome, Brian. Anytime.
So, markets are down. I think almost all of the benefit from the Donald Trump resurgence in the stock market has been erased. I went to an investment dinner that you had, when was it? 2 months ago, I think. And you were saying at the time there's a 20% chance of a recession. And with that, a chance for a decline in the stock market. And your 20% chance has become the reality. What did you expect this? Is this what you would thought would have happened with this pandemic, or has this been not enough or too much of a response in the market?
Yeah, there's nobody would have been able to predict what happened with the COVID-19. Throughout last year, in 2019, we were cautioning investors that the risks are just simply too high in the market. And the main concern for us was the amount of debt that exists in society. Canadians have more debt now than any other time before. So does Americans, corporations the same. Everybody is taking advantage of cheap interest rates and loading up debt, whether it's in real estate or credit card. And you add that to the other complications we've had, whether the impeachment of President Trump proceedings, or we had the trade war with China, or the possibility of war between US and Iran. We kept cautioning people that the risks are getting higher and higher, and they need to take a more conservative stance.
Sure.
If you had a good year in 2019, you should lock in these gains, find a way to remove money off the table. But unfortunately, like most people, they're driven either by greed or fear or indifference. And the greed, if you had 28% in 2019, you assume you're going to get the same in 2020. And a lot of people get caught off guard. Obviously, the COVID-19 throws everything in a tailspin in a sense, and it's hard to know which way the markets are going to go, but there's still that reality, and you can see it. I was talking to yesterday somebody, I said, imagine these big corporations, they don't even have cash to withstand their business coming to a halt for 2 weeks. We have not been under a massive stay-at-home order. We haven't been under a total shutdown. For probably it's been a period of 3 weeks, and you're starting to hear the bankruptcies one after the other.
Really, already you're hearing that?
Oh yeah, we're already. Boeing is asking, they halted trading on Boeing. A lot of oil and gas producers, a lot of airline industries. There's a 2.5 trillion aid package that's going through the U.S. Congress, mainly to help U.S. corporations. The layoffs that are occurring in all hotel operators, in restaurants. Companies were strapped for cash and they could not sustain their operation for even 1 week. And it's going to get worse. And now you lose loss of employment, and with the debt that we were warning about, you get the worst outcome. So then it becomes a cycle. And it's going to be a little bit of a vicious cycle, because if employment jumps 20%, when you have a lot of debt, either debt forgiveness is going to occur, which means banks are going to take these losses. If the government finances these losses, that means deteriorating the value of the currency. That also means higher taxes going forward as we come out of this. And we will eventually come out of this, but it's all that money that's being thrown at it has to be repaid at some point in time.
And you talk about how we're at all-time highs of debt, and what both the Federal Reserve did and the Bank of Canada is reduced interest rates to close to zero. If we've already got a bunch of debt, too much debt, is reducing interest rates to almost zero going to do any benefit?
We actually believe it will not stimulate demand. I actually believe it's a little bit in terms of economic impact, not productive at all. Because if I lose my job and my interest rate drops from on my mortgage from 2.5 to 1, even big deal.
But I was
My
surprised
problem.
a lot of banks in Canada actually increased their mortgage rates. Even while the Bank of Canada was reducing their interest rate, the mortgage rates went up.
That's a possibility, because actually, if you take a look at what's happening in the market, the 10-year treasuries are dropping, but the demand for short-term secure interest rates has been moving higher. It's just flight to capital, so it's a temporary thing.
Well, I was just looking at high yield bonds, and high yield bonds, the spread of high yield bonds to treasuries is as wide as it was in 2009. And
And
2 months
it's going
ago,
to get
it was very,
wider.
very small.
It's going to get wider, because the bankruptcy ratio of how many of these companies are functioning in a bankruptcy mode is going to increase. And I mean, you can hear it everywhere. Federal government in Canada and the US and in Europe, anywhere, everywhere, it has to give corporations a lending hand. And now they're talking about the federal government, and through the Federal Reserve, buying commercial paper, buying bonds of corporations, because nobody is lending.
Yeah.
We have a transaction that will be announced after market close today. We're among the very few companies out there, money managers, that are cash rich. Big part of it because of our concern in 2019. We entered this year with a lot of cash on behalf of our investors. So we're naturally buyers actually in this cycle, as opposed to sellers. So we're sitting here in our private equity business. We're seeing growth. We can get deals, bargains. When prices are this low and you have a lot of cash, you can be a shopper of some sort. But having cash means you have to be careful shopper.
We're going to take a break, and let me come back and after the break ask you whether this is actually a buying opportunity. So stay with us, everyone. We're going to come back with Hussein Ahmed, Yorkville Asset Management, on what's going to happen in the future, and is this should we continue selling, or is this a buying opportunity? Stay with us. Well, welcome back to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Hussein Ahmed, who is the founder of Yorkville Asset Management and head of this money management firm here in Toronto. And Hussein, you were just saying before the break that actually your firm is got cash because you cashed out in 2019, and that you're actually buying now. So do you think the stock market declines are now at a bottom and it is an opportunity to buy?
I don't think it's at a bottom. In fact, probably there's, in the stock market in general, there's probably another 10%, 15% that the markets could drop. When I say it's a buying opportunity, there's a massive amount of indiscriminate selling that occurs. So people liquidate an exchange traded fund, an ETF, or a mutual fund. They're selling the good, the bad, the ugly, all at the one time. So think of it, when you sell a mutual fund or an ETF, you're selling let's say Amazon with Ford Motor Company. Both stocks are owned in that fund. The fund owns more of Amazon than Ford Motor Company, but you're now selling Amazon. Amazon is a business that has been doing well before, and now they are hiring 100,000 new people during this crisis, and will continue to do well in the future, because the way our shopping has to change after this experience. So people are selling good companies with the bad companies, and this is what we refer to shunt stocks, and they shouldn't be dropping in value. So we'll naturally be shoppers of these.
Sorry, what are shunt stocks?
Shunt stocks meaning people have sold them, but they shouldn't be selling them. People are ignoring because of this act of indiscriminate selling. We will be posting that basket of recommended stocks. Of course, we do it on behalf of our clients, but we want to provide help for everybody. Amazon would be like, for example, one of them. Many in the healthcare space should be the same, that they are net beneficiary of what's happening here, but they're nevertheless being sold because people are selling what we call beta risk. Beta risk meaning you're selling your ETFs, you're selling your mutual funds, and in that you're selling the good companies with the bad companies.
I saw a fascinating article talking about Amazon and Jeff Bezos actually, that said that unlike a lot of executives that were just sort of hoping this thing would go away and were hunkering down and waiting it out, he was using this as an opportunity to reinvent his business. And he sent a 4-page letter to all of his employees talking about, this is the new normal. This is going to be around for a while. And we've got to think about what we would do to deliver all of our products via online, which is obviously the business that they were in, but that exploiting this opportunity and making it a new business strategy and a new business reality. And the article was suggesting not enough companies, not enough executives are actually coming to the reality of the world that we're going to be in for the next month or more, and reinventing their business for this new reality. Do you agree with that?
If this crisis ends up being COVID-19 becomes the number one killer, surpassing heart attacks and cancer, we will overcome it. Eventually, there'll be some vaccine. Eventually, there's some way to control it. But the main challenge for businesses is realizing life as we know it changed.
Yep.
How we communicate with other change. We are now more experienced using Zoom than ever before. Some companies were ahead of the curve versus others. But I think all in all, things are going to change. Even if this COVID-19 is behind us in a month or so, we don't think so. We think it's going to last till July. But having said that, business as we know it changes. The second trade, when I was telling you about opportunities, funny you mentioned Jeff Bezos, but the first trade we called it chum stock. The other one is investing with America's elite. In 2008, we came to the realization that business owners, the ones that have majority stake in their companies, they are leading the curve in protecting their businesses, as opposed to businesses that do not have a majority shareholder. I'm a business owner, you are, and others. And we know that we will go the distance for our businesses to make sure they're leading the curve and ahead of everybody else for them to survive and grow. Jeff Bezos is being one of them. In 2008, for example, we decided to invest in Ford Motor Company. At that time, Ford was trading just under $2 because we realized Ford family is not going to let Ford Motor Company being nationalized by the US government. We did the same with Las Vegas Sand and Sheldon Adelson, realizing that these families have been around since the 30s. They have a lot of money invested in these companies, and they're not just going to let them go and be nationalized or go bankrupt.
Right.
So investing with a company that has a substantial interest from a business owner is very important, as opposed to companies that have did their IPO. There is no single individual owners. All the owners are fund managers. Fund managers like ourselves provide a great benefit, but also at some time, we don't have a loyalty to a company of some sort. We're just, sad to say, chasing returns. So we will gladly sell a position in favor for the others. But a business owner is not gonna, Jeff Bezos is not gonna say, oh, my stock is gonna drop, I'm gonna sell before it drops. Say, hey, if it drops, I'm buying more of it, that's fine. And I use Jeff Bezos because you brought that example, but there's plenty of companies in Canada and the US where is that individual family ownership is gonna make a difference on one level. The second level, who's ahead of the curve and who's accepting the reality that even if this ends tomorrow, the life as we know it before, how we interact, how we communicate, how we deliver our products and consumers to the end consumer has changed. So those are the two companies that will be type of companies that will be the net beneficiaries and winners in the cycle.
So that's kind of interesting. It's almost like you're criticizing, capitalism or shareholder owned companies. And you're going back to what we need is to have significant shareholders with significant positions in their companies. And those are the ones that you want to invest in because they make better decisions for their own assets and their own shareholders.
They do. And individual shareholders, families that have businesses, it's a balancing act between an individual like Jeff Bezos needing investment money, and he has to approach capital markets, and he has to have an indirect form of partnership with shareholders, with other investors. It's a balancing act between those those who have capital and those that need it. Today, Jeff Bezos has the capital, but if you take it back 15, 20 years ago, he actually needed the stock market to launch Amazon and get it to where it is. So it's a tight balancing act, but we find when the owner is still around and in our research, and he's a leading figurehead, he is more inclined to use his own financial resources, as Sheldon Adelson did with Las Vegas Sands in 2008, 2009, or Ford Motor Company, extend loans to his own companies because he cannot be at the mercy of banks when they are cutting interest rates. Today or yesterday, you'll see news on MGM and BlackRock, and they're struggling in terms of how much are they going to extend to the MGM, versus you're not going to hear this on Las Vegas Sands, or let's say the Wynn, where Steve Wynn is willing to come back and say, hey, I'll extend the loan, not a problem. It's my company. I want to stay the majority shareholder.
You know, it's interesting. I've had the privilege of working for the Walt Disney Company. Roy Disney was still involved in the board of directors and ran the animation business at the time. I worked for the Molson companies when Eric Molson was chairman of the board and still very involved in the board of the companies. And I worked for a private company by the name of the Pattison Group with Jim Pattison running the company. And you know, I think that you're right that each one of those executives that either had their name on the front door, Disney and Molson and Pattison, and or had significant equity ownership positions in the company, did act very differently than someone that's just getting a $1 million or so salary and a bunch of options.
Absolutely. People forget that Disney was going into bankruptcy, and Walt Disney himself had to put his insurance policy actually as a collateral, personal insurance policy as a collateral for loans for his company that allowed the company to move on. I doubt you're going to get this from the CEO, the ex-CEO of Boeing, that just got ousted in January, that received a paycheck for $62 million. I doubt if now they're going to tell him, hey, Boeing is struggling, we need that money back, or even can you lend it to Boeing? I don't think he's going to do that. So that's a key difference that I think investors need to realize. But that's why portfolio managers like ourselves, and there's many out there that are good in doing this stuff, they need people that can decipher this information for them.
So if people are interested in looking at companies where either you think that they're adapting to the new reality like Amazon, and or they've got significant shareholders that are owners of the companies, where would they find that list or those lists?
We try to provide information on our webpage, but because of security rules and regulations, we cannot provide it before we do. So it's a little bit, by the time you see it on our news, like anything you see on the news, it has happened already.
Right.
I would suggest for people to speak to their financial advisors. We always say to people, there's your health, your family, and your wealth. So wealth gotta be up there among the top 3 things in your life. You gotta engage your portfolio manager, see what ideas they're coming up with, or your financial advisors. There are plenty out there that can do help. Of course, Yorkville is willing to help, but they have to start that discussion, and they have to make sure that there's continuous and active engagement with their money manager. We are doing probably every morning and every other night an update via Zoom for our clients in terms of what we're doing and what we're planning to change, because transparency is very important, and we need them to understand what is our game plan in this period, in this environment.
Now, probably most of your clients are high net worth individuals. Let me change topics for a second. I chatted with my mom this weekend. She's a senior citizen. She's on a fixed income. She's got some assets that have been socked away, and she has lost so much money on paper in her portfolio in the last couple of weeks. It's astounding, and that was her nest egg. That was what she was going to live on for the rest of her life. What do you say to seniors that are in that kind of a position?
It is tough. I would say originally, I mean, when we take a look at somebody, a key determinant of where they are going to be investing is age. Age becomes an important factor.
For sure.
So as a senior, I would say they have to have been very careful going into the cycle after age 65. The bulk of their investment should be in fixed income. So if you take a look at the performance of fixed income bonds across the board, including in Yorkville, we have a retail side of our business, and we have the high net worth clients. On the retail side, you'll find the bonds are doing very well. When yields do drop, bondholders benefit actually. Our bond is predominantly government securities and banks, so it's a net beneficiary. So I would say to a senior, or anybody who's entering that stage, asset mix is not something we just teach about. It's a reality. As you get older, you should be increasing your allocation to fixed income and less to equities and less into commodities. These are more volatile. And what you've gained in 4 years, it was wiped out in a week.
Yep.
So that's the reality. So that's number one to seniors. That anybody who's thinking of investments, to make sure you keep an eye on the asset mix. The second thing, in terms of people that lost a lot of money now, an unfortunate situation, a recovery will happen at some point in time. But do you want to stay? If you drop 10% to get back to zero, your portfolio manager or your investment has to gain 20 just to get back to zero. So do you want to stay in the same strategy, or do you want to shift at this time to capitalize on either more protection on the downside or getting higher torque on the upside? So those are, again, discussions that you need to have with individuals that have lost a lot of money, whether they are senior or younger at age. That discussion needs to happen with their investment advisor, and sooner rather than later.
Right.
Keeping things as they are, stay the course, all that stuff. That normally happens under normal corrections, as happened in 2019. In the fourth quarter, market drops 20%. But if you were away for a week, you would not have even noticed it. That's a V-shaped recovery. But if ends up a U-shaped recovery with an extended bottom of the U, like what happened 2008, 2009, or even worse, like what happened in 2000, when the dot-com bubble burst, when stocks dropped, and it took almost 8 years for Microsoft, for example, as a stock, and it's a great company, to get back to where it was. If this is such a long cycle, people have to be careful. Now, you got to remember, in all cycles, in 2009, 2008, I highlighted two names that we made money from, substantial amount of money. It wasn't like they just went up 10, 20%. Ford Motor Company went from 2 to 18. Las Vegas Sands went from $2.50 to $56. Even in 2000, there's plenty of companies, while Nortel was going bankrupt, there's plenty of companies that actually did very well. So a shift in strategy is warranted, and that can only occur with a discussion with your investment advisor.
Well, that's great advice. We're going to take another break and come back with more conversation with Hussein Ahmed. And I'm going to ask him whether he thinks this is a 2000, 2008, or 2019 type recovery, and what he thinks government should do. Stay with us. We're going to come back just in a minute. Well, welcome back. We're chatting with Hussein Ahmed, who is the head of Yorkville Asset Management and money management firm here in Toronto. And he's given us a great review of what's happened with COVID-19, as well as what he thinks should be happening. And I guess you were just, Hussein, talking about the 2000 recovery that took quite a long time, 8 years for Microsoft to come back, versus the 2008-9 decline that took, I think you said 18 months to come back, versus a V-shaped recovery in 2019 that if you had gone away for a week, you wouldn't even notice the decline. Given what's happened, people are talking about 20% unemployment, maybe more, a month, if not 3 months of no business. This week we've got a shutdown of businesses for a minimum of 2 weeks, where anyone other than essential services have to close their offices. What do you think? Is it going to be 8 years? Is it going to be 18 months? Or is it going to be a month?
I don't think it's going to be a V-shaped recovery, because even though everything being thrown at this from the Federal Reserve or Bank of Canada or fiscally is being thrown at it, till we find a solution to this COVID-19, we're going to continue to hear negative news. And negative news has an impact on investor sentiment, on consumer sentiment. And you're going to hear bankruptcies, layoffs, delinquencies, and all that stuff for at least the next 2 months. That's going to give markets basically a headwind from them to recover quickly. But as I said, in 2008, even as markets were going down, healthcare sector, for example, it was called the Great Financial Crisis. Healthcare companies did exceptionally well, for example. In 2000, when we take a look at the dot-com bubble, it was anything that was related to technology was being affected negatively, but different sectors continued to do well. So you have to be very careful in that. We don't. We are positioned now for my colleague speaking to my before this call with our investment committee. We're positioned for maximum defensiveness, meaning we have a lot of hedges, insurance on our portfolios. We have even gold in our portfolio, something we've never
Gold,
owned.
really?
Yeah, we have gold. We have about 10%, 5 to 10% in gold. So we're for the time being, we are maximum defensiveness, and we have a great alpha outperformance against the market of roughly 11 to 14% across all our funds. But on the other side, we cannot ignore the fact, like I said, that there could be an opportunity to buy these companies, the shunt stocks or the ones that are owned by American elite, so we can start participating in the recovery before the recovery actually occurs. So you're caught in between. In terms of a decision, is it a V-shape, L-shape, U-shaped recovery? The L-shaped is the one in 2000. That took a long period of time for the stock market to go above water back again. Took almost 4 or 5 years. We do not know. We're in uncharted territory, but we are not invested in the broader market. We do not offer our clients a beta risk like an ETF. We're not. Our funds are very specific. We have a large exposure to the healthcare sector. Healthcare, anything you Google on Yorkville Asset Management is healthcare dominated investments. And we think 50% of this fiscal stimulus that you hear that's around the world is going to end up in the healthcare system, whether we're building hospitals, equipment, masks, whatever it is. So we feel our clients are going to be net beneficiary of this thing. The second thing is insurance. So we're hedging the portfolios against the worst outcome that could possibly occur, where unemployment jumps 20, 30%, and we have a massive contraction in economy. I don't know what we'll call it. It's not a recession. It could be a depression, could be another Great Depression. You got to remember in 1929, 1933, when we had such a contraction in economic output, Americans did not have a lot of debt. This situation is much worse. Americans, and when I say Americans, North Americans have a lot of debt. So the problem could be worse. We're positioned for that, but we also want to participate in that cycle up. And you got to remember.
You think there's a chance of that, of a depression, of several years of economic contraction?
If they do not control COVID-19, and this ends up we're sitting here doing another phone call, me and you, in October, November this year, and massive lockdown, airlines are shut down, and things have not progressed much better than where they are now, that possibility is very high.
So Donald Trump, President Donald Trump, has been talking about a pop. He says the pop is going to be beautiful. It's going to be huge. It's going to be big.
Yeah, it is a possibility. A politician has to be an optimist, no different than a typical portfolio manager. We have to be an optimist at some level, even as individuals. We have to be at that. But there's a reality when we're talking about a pandemic that so far, with all our knowledge and resources, there has not been a quick vaccine to solve this problem. And you keep hearing shutdown, South Africa, Italy, Spain, the UK now is making more aggressive moves. The pop could occur, but the problem, if it occurs after we go bankrupt, who cares?
Yeah.
We need the pop to occur while we still have our investments. It cannot be a dollar short and a day late. It doesn't work that way. So yes, pop will occur and will benefit people. And I'll take you back in history. In the 1930s, most of the wealth that we know now in America, whether it's the Kraft, the Kellogg's, the Ford Motor Company, occurred with a smaller percentage of the population. And that wealth is now worth trillions of dollars. But the absolute majority, population-wise, ended up being losers. So we have to be very careful in this cycle.
And so what you're saying is that some of the wealthiest families in America started during that depression. What was it that they were doing during the depression that created that wealth?
Absolutely. First of all, they had cash. cash, and they were business owners. They didn't need jobs, so they were not dependent on employment. Number two, they had cash, and when they had cash, they allowed them to consolidate in their businesses.
Right.
And you could see a small business acquiring a bigger one, simply put, because the bigger one runs out of cash.
Right.
We're sitting here at Yorkville Asset Management and saying, hey, we're cash rich now. We can go,
How's the time to
everybody
make
that,
moves?
yeah, everybody we tried to buy before was asking for ridiculous premium for their businesses. I bet you that that situation is changing now and very quickly. If you don't have cash to pay your employees, you cannot sustain operations. And that was happening in that late 20s, early 30s, that people that had cash, no matter how small it was, they were able to capitalize and acquire either companies that complemented their businesses or competed with them and allowed them to grow at a much faster rate if it wasn't occurred.
Right.
And if you can Google these names, they've been around since the 30s. And they're now the ones that own football teams, they're the ones that own multiple businesses, their brand name is everywhere. And since then, there has been no amount of wealth created in that magnitude in the 30s, 40s, or again, it occurred in the 70s. But it's an opportunity to create wealth if you're sitting on a lot of cash.
You know, it's interesting because there's been a fair amount of academic research on exactly this topic of, during a downturn, is it the time to hunker down or is it the time to actually be aggressive and expand? And if you have the cash and if you have the wherewithal, the answer has always been that's actually the time to take advantage. And so it comes back to sort of the old adage about buy low, sell high. And too many people, when it's low, they get scared and hunker down and aren't willing to do anything. And when it's high, they get excited and keep on buying. And so too many people buy high and sell low rather than buying low and selling high.
Absolutely, you're so right in this. I mean, it's we see it every day. We're sitting now, but having cash. I just want to be careful with what we convey to the public. We have a lot of cash. We're almost 30% in cash across, and we have a lot of it, more from the insurance and the gold. But what you want to be careful is similar as you going shopping, no different than shopping in a car. Just because you have cash and there's a deal on the car today, you don't necessarily say, okay, I'm going to do it. It implies you have to be much more careful shopper with your cash. So it's a great position to be in, but you have to be a very careful shopper.
Okay, good advice. So what about governments? Prime Minister Trudeau has been bragging that we have the lowest debt to GDP of any country in the G7. Obviously a fairly sizable stimulus package, but the US stimulus package looks like it's even more. And then you've got examples of Denmark that are coming out with unbelievably large stimulus packages and are covering up to 75% of the wages of laid off workers. And what do you think government should be doing? You've already said that you think that lowering the interest rates to almost zero isn't going to have much of an impact. What do you think government should be doing?
I think there's a different policy, monetary policy versus fiscal policy. Monetary policy, keep cutting interest rates till they get to zero and negative. I think at some point in time, that is not necessarily effective. We went through it in Europe, and some people argue it was effective, but the majority will acknowledge now it wasn't that effective. On the fiscal stimulus, having a low debt to GDP ratio, that's great actually, and our Prime Minister is correct. However, you're going to see that fiscal stimulus and budget deficit balloon over the next 6-7 months. And having that debt capacity is actually an advantage for Canada because unlike many countries where debt to GDP is at 8 and 9 and they cannot borrow anymore, Canada has the ability to borrow in order to finance those needs. The biggest challenge is how do we get these programs working? So they announced 10% employment subsidies. They announced temporary unemployment to help companies. The biggest challenge is how do we get them working? As you know, a big announcement and the administrative process is a nightmare. That's going to slow down a lot of things. And like I said, a program working a day after a business goes bankrupt, it's irrelevant. You could make any announcement you want about it, but if it starts working on Tuesday and you go bankrupt on Monday, that's not going to help. So the biggest thing we're going to see is two things, and I think they have to come to this realization, and I think they're doing the right things. One is increasing the amount of fiscal stimulus. I think the last announcement that I heard was 85 billion. That is going to be almost, when we're done, 10 times that, if not more than 10
10
times.
times that.
Yeah, yes. If you take a look at what Italy is doing, at what Germany is doing, what Spain is doing, what the US is going to do, and you take it per individual, you say 85 billion is not enough. It's not going to move the needle. That 85 billion um, assumes the problem is here for 2 weeks,
Right.
and that's unrealistic. So we're going to see that number increase quite a bit. I don't know if it's 10 times, it could be 3 times, it could be 20 times, but that number alone, when we do the math based on the number of hospital beds we have, the number of ICUs, the number of ventilators, say there is no way that this 85 billion can do anything. As you know, we're a major player in long-term healthcare facilities. We have about 2,400 beds in Ontario. That amount is a drop in an ocean. It means
Really?
nothing. You got to increase that amount substantially if you want to solve the problem. Then you talk about support for the businesses, unemployment, and all that stuff. You got to add it up, and you quickly realize, just on the back of an envelope, that 85 billion is a good first reaction. It's comforting, but you definitely need way more than that. But the second thing, which is more important probably than the dollar amount, you could announce the dollar amount, 85 million, is to make sure programs can effectively work and simple and easy. If they tell you there's a 10% employment subsidy on salaries, you cannot go in there and now start filling 70 application forms and submit them and let a bureaucrat who's now working at home make the decision, and takes you 10 weeks, because you might get the subsidy the day after you go bankrupt.
Right.
And for a lot of businesses that are cash strapped, this is day by day. Some businesses are ahead of it, but that means they fire people very quickly, which we hope this doesn't happen. But that administrative process has to become very quickly, and that's a bigger challenge, I think,
So
for the government.
it sounds to me like you think the number one priority is don't allow companies to go bankrupt.
Absolutely. That is, if a company goes bankrupt, it's hard for it to restart again.
Yeah.
Because having a company started needs not just financial, needs that intellectual capital, needs that entrepreneurial drive. And if that is crushed, if that entrepreneur is bruised, beaten up, lost everything, it's hard to get him restarted. You can throw money at people, but if they don't have that entrepreneurial drive to start a business, they're not going to do anything with that money. They'll waste it in restaurants and all different useless things.
Yeah.
But you got to make sure those entrepreneurs that have risked a lot to get their businesses going, that are employers in Canada, they are the source of GDP. You got to make sure they do not go bankrupt, and you got to make sure that this happens quickly.
We're going to take a break and come back with Hussein Ahmed in just a minute. And I'm going to ask him about a couple of other markets. Stay with us. Well, we're back with Hussein Ahmed, the founder and owner and head of Yorkville Asset Management, a money management firm here in Toronto. We're talking about the impact of COVID-19 on the markets and on business and on strategy. We're just talking about what government should do. Maybe, Hussein, I could ask you about a couple of other markets if I could. IPO market. One of the companies that was touted to be going public in 2020, one of the biggest companies, was Airbnb. And I guess they've put their public offering on hold because people aren't traveling as much, but also the markets are pretty crappy. A lot of technology companies and healthcare companies were on fire last year. The IPO market, the IPO window was very attractive, but has sort of closed right now. What's your prediction for the IPOs in the coming months?
I think the IPO market for now is on hold, unless it's a healthcare company of some sort. That window remains open for them. But in general, the IPO market is going to be on hold for an extended period of time for a number of reasons. One, liquidity is drying up in general in the market. Two, the willingness of banks to take that aggressive move and take a company on and try to sell its shares. It's not going to happen. Banks are in retrenchment. And third, the investors are really bruised that very select companies, like, for example, Zoom, is doing exceptionally well. Unless a company has that competitive advantage in a certain areas that they can prove that no, doesn't matter what's happening. We're here to help with what's happening.
Yep.
So for the time being, that IPO market definitely is on hold. What does that mean? We're going to see a surge in private equity transactions. So, a company like us, you'll hear later today an announcement in the private equity space. You're going to see investment firms that have a private equity business offering do exceptionally well because they're going to replace that IPO market for the time being.
So if you were at a company that was planning on going public, your advice would be go and meet the private equity market.
Absolutely.
Okay. What about the real estate market? You talked about, high levels of personal debt. Interest rates are at an all-time low. I think that in your investment dinner a couple of months ago, you talked about how the real estate market was very, very high. What's your prediction of what COVID-19 will do with the real estate market in Toronto and Canada generally?
Sure. Well, it's a cycle. It's between banks lending for real estate, low interest rates, the price of real estate, and capacity. Like it's that cycle. So now we've seen the federal government in the U.S., for example, the Federal Reserve taking on $500 billion of mortgage-backed securities because they want to remove the default risk from the banks. So on one side, they're saying, hey, if mortgages are in default, not to worry, the federal government owns these mortgages at some level. Then you get the banks, the Canadian banks are talking about giving Canadians, for example, a mortgage holiday of some sort,
right,
meaning don't pay your next two mortgage payments. We'll tag them on. It's not that they're forgiving you for them, but we'll tag them on, we'll spread them over the next term of the mortgage, 6, 7, 10 years, whatever the term you have left. So for the time being, the program is meant to stabilize what's happening in real estate market, but this is as a result of a fear that government has that if there's a drop of 30, 40, 50% in the prices of real estate, Canadian savings are in two or three places. One, the biggest savings is in the real estate, the value of their homes. Two, in their mutual funds, RRSPs, and these are getting a beating. And three is in cash sitting in banks. And let me tell you, the number three, cash, is not a big amount. It's number one is the real estate. And if that's going to get crushed, your ability to borrow while you're unemployed on an equity loan is going to be diminished. So that's a big priority, I would believe, should be a big priority for the bankers and the government. But what we anticipate is going to happen in two things. I can speak a little bit on Yorkville position. We have not owned real estate for a long period of time. We believe that real estate is too expensive. And we believe also the debt is too high with Canadians, that at some point in time, the market is going to crack. We were wrong in 2018, 2019, but I don't think we're going to be wrong for too long. This is going to happen. So we do see prices of real estate dropping down, and we are going to see a shift actually in consumers' buying patterns. These apartment buildings and condominiums that are being built everywhere, there's a massive amount of debt on them. I'm not sure if they're going to be able to continue building them, getting the finances. Some will, some won't. But the consumer has to shift. As you know, the bulk of the transmission of this COVID-19 happens in condensed areas. So
right.
An apartment building is more condensed than when somebody lives in a house and your neighbor is away from you easily 200 feet, So you're going to find that consumer buying patterns are going to change over time. So capacity utilization in condominiums in the city of Toronto, for example, will start changing.
Really?
So that's one thing. But we do think prices are going to drop for a number of reasons. There is no buyers in the market. There is no lenders, or the lending capacity is drying up very quickly with the banks. And if you haven't if you have a property that you're in the middle of developing it, you want to put it on the market to sell, guess what? It's been on the market for a while, and now with this COVID-19, it's going to be on the market for a little bit longer, or much longer.
So if you were going to buy, you would hold off?
I would hold off, yes.
And if you were going to sell, you would sell real quick?
I would sell real quick.
Okay. Hussein Ahmed, thank you very much for joining us today. I really appreciate your insights. If people want to access your services, do you have a website that they can connect up with?
Yeah, the company name is Yorkville Asset Management. The website is yorkvilleasset.com. My telephone number, my email is on the line, is on the web. So please feel free to reach out to me or any of my colleagues on the client service team that will be happy to help.
Hussein Ahmed, in this very difficult time where people are worried about their health and the health of their loved ones, you're right. They're also worried about their wealth, and that wealth is something that they were planning on having to keep them healthy and wealthy and alive for a long period of time. And a lot of us have seen that wealth diminish over the course of the last couple of weeks. And so advice from someone as smart and as experienced as you is very helpful. Thank you very much for your time.
Thank you.
Good night, everybody. Appreciate your time.
Good night.
Bye.